Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at critical metals.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, so the last 3 months for this company have been, well, a whirlwind. A lot of activity, mostly around equity financing.
A huge amount.
When you see that sheer volume of filings, the S8s, the F3s, what's the story that tells you?
The story is one of transition. It really signals a company moving from a sort of quiet, illiquid developer to a fully public operational entity.
It's the mechanics of growing up, basically.
Yeah, exactly. It's the cost of growth.
So let's break down those mechanics.
Okay, so first, they filed a Form S8. That registered over 18.1 million new ordinary shares.
And that's for their incentive award plan.
Right. It's a compensation pool. They're gearing up to attract the high-level management and engineers they need to actually get these mines producing.
So future dilution, but it's earmarked for talent. That makes sense.
Precisely. But then, and this is where it gets really interesting, right after that, they filed Form F3 resale registrations for up to 18 million shares.
Okay, so what's an F3 in simple terms?
It's essentially an exit ramp. It gives prior investors, the ones who took on massive risk early on with things like warrants, a way to sell their shares efficiently on the open market.
So the company's saying we're hiring new talent with stock, but at the same time, we're getting the paperwork ready for our early backers to cash out.
You've got it. That creates a potential supply overhang on the market, no doubt. But it's all about preparing for liquidity.
And that liquidity push really started with that big PIPE deal, the private investment in public equity. That closed in September.
That PIPE was absolutely crucial. It brought in fresh cash.
How did that one work?
They issued about 1.47 million ordinary shares and another 1.56 million pre-funded warrants. It was necessary cash, but, it also bumped up the total outstanding share count to around 117.7 million.
More of that expected dilution.
Right. But it's also about who is selling.
We saw European Lithium thinning their position, didn't we?
We did. They amended their filing, recording the sale of 3 million shares. And that's actually a good thing for the market.
How so?
Because it creates liquidity. When a stock is too tightly held, big institutions can't buy in without sending the price to the moon. These kinds of block sales open the door for new, bigger players to come in.
We also saw some Form 144 notices that suggests insiders are getting ready to sell. When you see that, is it time to worry?
It's rarely a red flag by itself, not at this stage. You have to look at the context.
And the context is?
These are the early investors who got in years ago when the risk was just astronomical.
So they're just taking some profits off the table.
It's a normalization phase. Yes, it adds some selling pressure short term, but it paves the way for new long-term institutions to build a position. It's all part of the process.
That's a great summary. It's the messy paperwork of becoming a real publicly traded company. So let's pivot from that to the fundamentals.
Let's do it. And you have to start with the huge positive here.
Revenue growth.
The revenue growth. It's just exceptional. For their last fiscal year, it soared 376.5% year over year, up to about $560,000.
That growth rate is staggering. But let's be honest, $560,000 in revenue isn't going to build a mine. Are they still burning through cash?
Oh, absolutely. The margins are still negative, which you'd expect. But here's the key improvement, the net loss. They cut it by 62.8% from the year before.
That's a huge improvement in efficiency.
It is. The loss is still around, 51.87 million? But cutting the burn that much while revenue explodes shows that management has a real handle on cost as they scale.
Okay, a $51 million loss is still a big number. How does the balance sheet look overall?
Long term, it's actually pretty solid. They have very low leverage. The debt-to-equity ratio is just 0.16.
So they're not weighed down by a lot of debt.
Not at all. That gives them huge flexibility for future financing or partnerships for those big projects in Austria and Greenland.
But future flexibility doesn't pay today's bills. What's the big glaring weakness right now?
It's the short-term liquidity. This is the crucial risk factor.
How bad is it?
The current ratio and the quick ratio. They're both sitting at 0.13.
Wow, wait. 0.13, can you break that down for our listeners? What does that actually mean in the real world?
Think of it like this. For every dollar in bills they have due in the next year, they only have 13 cents in cash or liquid assets to pay for it.
So they're walking a financial tightrope. No safety net.
Exactly. It makes them completely dependent on either getting cash flow up and running fast or raising more money. It's the reality until the big projects are online.
Okay, so with that huge liquidity risk, why is the smart money so convinced? Let's talk about their strategic position in Europe.
This is the other side of the coin. The company is just perfectly positioned for this massive geopolitical shift. The EU is desperate for its own supply of critical minerals.
To move away from reliance on other countries?
Exactly. And critical metals assets in Austria and Greenland make them a prime candidate to be that domestic strategic supplier. They're almost politically insulated.
So they're not just selling minerals, they're selling strategic independence.
You absolutely nailed it. And that's why institutional conviction is through the roof. Ownership stands at a massive 86.44%.
86%.
Yeah.
That tells you that the biggest players out there believe the long-term strategic value completely outweighs these short-term liquidity risks.
It's a huge vote of confidence.
Okay, so let's connect that confidence to the charts. What's the technical picture telling us?
Well, the chart really confirms that institutional interest. We're in a robust, short-term, bullish trend.
What does that look like?
You see a clear pattern of higher lows and higher highs going back to June. And importantly, the price is trading above both the 50-day and the 200-day moving averages.
Classic confirmation of an uptrend.
Right. It's a textbook accumulation phase.
And what about momentum? Is the stock getting overbought? Is there still room to run?
All signs point to yes, there's room. The MACD is showing a positive crossover, which is bullish. But the really interesting one is the Stochh HRSI. It's sitting incredibly low, around 10.82.
For those who don't follow that indicator, a reading of 10.82 implies what exactly?
Anything below 20 is generally considered oversold, or at the very least not overbought.
So the trend is strong, but the recent momentum hasn't been crazy.
Right. It suggests the stock hasn't gotten too hot yet. There's significant room for it to move up without overheating.
That's a powerful setup. You've got fundamental belief from institutions, a strong technical trend, and it's still not overextended. So for traders, what are the key price levels to watch?
The trading range is pretty well defined. Your floor, the absolute key support level, is solid at $14.71.
You don't want to see it break that.
A break there would be a major problem. On the upside, the big historical resistance is way up near $47.59, but the more immediate hurdle was around $19.55.
And with the stock recently trading around $20.86, it's already cleared that first hurdle.
It has. So as long as volume stays strong and that $14.71 sunk floor holds, the technical picture looks very, very constructive. It shows you the institutions are absorbing any selling.
Okay, let's look ahead. What are the upcoming events, the catalysts that could really move the needle in the next 3 to 6 months?
The first big one is coming up fast. The Q3 earnings release on November 25th. This report is going to be under a microscope.
Because they just raised all that cash.
Exactly. The market needs to see that the money's being put to good use and that they're continuing that trend of cutting their losses. It's the first real proof point.
And outside of the company itself, December is always a busy month. What should we be watching for?
2 dates stand out. Around December 2nd, you've got major ETF index rebalancing.
Which could force funds to buy or sell.
It can, yeah. It just mechanically drives turnover. Then around December 15th, we get the institutional buy-in disclosures. That's when we'll see which big funds were buying during that last volatile quarter.
All right, now for the fun stuff, the speculation. What's the credible chatter out there that could really change the story here?
Okay, there are 3 powerful rumors circulating. The first one is about fast-tracking the development of the Greenland Tanbreeze mine.
Advancing the timeline.
If they can bring production forward by, say, 6 or 12 months, that completely changes the valuation model for the entire company. It's huge.
That would be a game changer. What's number 2?
Talk of a potential strategic joint venture, a JV, probably with a major global metals firm.
And that's not just about money, right?
No, not at all. A partner like that brings deep pockets, yes, but also existing infrastructure and, crucially, immediate market access. It would be a massive validation of their assets.
And the third piece of buzz.
That's more technical. It's chatter about being included in more niche Nasdaq specialty metal or clean tech indices.
And if that happens.
It drives mandatory buying from passive funds. They have to own the stock, which creates a really powerful and sustained tailwind for the price.
So let's try to tie all this together. What's the central trade-off here for someone looking at this stock?
You're betting on execution, really. The company has this massive upside potential. You see it in the 376% revenue growth, the huge institutional backing, the strategic assets, but you have to balance that against the very real, very clear short-term financing needs.
Let's just summarize those core risks one more time.
Sure. Risk number one is that weak short-term liquidity. Remember that 0.13 current ratio? It's
Hmm.
critical. Number two is just high sector volatility, commodity prices swing. And number three is execution risk. They simply have to deliver on getting those big mines commercialized.
Okay, so on the flip side, why are these huge, sophisticated funds willing to take on that risk? What's the reward?
The reward is the strategic position. That 86% institutional ownership isn't an accident. They see the unique value of a European supplier in a world that's desperate for these metals. And you have that pipeline of catalyst earnings, project news, a potential JV all lined up to potentially re-rate the stock in the near term. It's a bet on strategic assets navigating a period of financial fragility. You have to watch both sides of the story very closely.
You do. The key going forward will be watching if the Q3 earnings validate all this aggressive capital raising. We need to see that they're making corresponding, measurable progress in moving the Greenland and Austrian assets closer to full commercialization. That's the number that ties everything we've talked about together.